Understanding MiFID II, the European Union's comprehensive financial regulation. Introduction. In the wake of the global financial crisis of 2008, which exposed significant vulnerabilities in financial regulatory frameworks worldwide, the European Union (EU) enacted the Markets in Financial Instruments Directive II, or MiFID II. Implemented on January 3, 2018, this legislation aims to enhance investor protection and improve the transparency and efficiency of EU financial markets. MiFID II is a comprehensive set of rules affecting almost every aspect of the financial services industry, ranging from investment firms to trading venues and beyond. Key takeaways. Implementation date: MiFID II was rolled out in 2018. Scope: covers virtually all assets and professions in the EU financial services market. Market structure: regulates off-exchange, over-the-counter, OTC, transactions, pushing trading onto formal exchanges. Transparency: enhances transparency concerning trading costs and transaction records. Background to MiFID II. The original MiFID, brought into effect in November 2007, aimed primarily at equity markets but was quickly deemed inadequate due to the financial crisis. Critics argued its narrow focus sidelined other essential asset classes, including fixed income, derivatives, and commodities. Recognizing these gaps, MiFID II not only updates but expands the original directive, encompassing a wider array of financial instruments. Goals and objectives. MiFID II has several pivotal goals. 1. Enhancing transparency, improving the availability of data regarding trades and costs associated with investment services. 2. Protecting investors, establishing clear regulations to mitigate conflicts of interest and ensuring that financial advice is aimed at serving clients' best interests. 3. Standardizing market practices, creating a uniform regulatory environment across EU member states, thereby enhancing cooperation and oversight. Major changes introduced by MiFID II. MiFID II introduces a range of significant regulations that transform how financial markets operate within the EU. 1. Regulated trading framework. MiFID II mandates a transition from dark pools and OTC trading to organized trading environments. One crucial addition is the Organized Trading Facility (OTF), designed to capture previously unregulated trades. Moreover, investment firms executing client orders must register as multilateral trading facilities (MTFs). 2. Enhanced transparency specifications. Financial institutions are now required to publish their bid and offer prices for securities continuously. Additionally, the separation of costs for research and transactions fosters transparency in pricing, allowing investors to clearly understand the services they are paying for. It encourages better quality research as the expenses are now distinguishable. 3. Stricter investor protection measures. MiFID II has instituted stringent guidelines that restrict inducements, essentially curbing any third-party payments to financial advisors that could lead to potential conflicts of interest. 4. Robust reporting requirements. Investment firms must provide regulators with detailed reports of their transactions within 24 hours, along with comprehensive communications documentation. This level of scrutiny enhances the ability of regulators to detect and prevent market abuses. 5. High-frequency trading, HFT, oversight. The legislation enforces tighter regulations on algorithmic and high-frequency trading, ensuring market stability. This includes a requirement that algorithms be tested and documented, fostering compliance with regulatory standards. Future developments in MiFID II. The EU has enacted a review process that began in 2020, leading to proposed changes aimed at further bolstering transparency and resolving conflicts of interest. Proposed updates include consolidating data feeds across Europe and implementing a ban on payment for order flow, PFOF. Furthermore, emergency measures will require regulated markets to have protocols ready for immediate action in response to significant market fluctuations. What about dark pools? Dark pools are private exchanges that enable trading without public visibility, providing liquidity for large transactions while shielding market-sensitive information. Though they offer advantages, their lack of transparency raises concerns about the potential for manipulation and inequitable trading practices. Global perspective, U.S. regulations compared to MiFID II. The U.S. financial regulatory framework encompasses various laws that echo the principles of MiFID II, including the Securities Exchange Act of 1934, Regulation Alternative Trading System, 1998, Regulation National Market System, 2005. Each of these regulations aims to enhance market integrity, promote transparency, and protect investors, thereby reflecting similar objectives to those outlined in MiFID II. The post-Brexit between the EU and UK. The dynamic following Brexit has resulted in the UK reassessing its financial regulations, moving towards sustainable deregulation while initially incorporating MiFID II provisions for stability. As the UK looks to assert its role in global finance, its regulatory landscape may continue to evolve independently of MiFID II. Conclusion: MiFID II represents a landmark regulatory framework designed to restore faith in financial markets in the wake of previous crises. By prioritizing transparency, investor protection, and standardized practices across member states, MiFID II has set a precedent for financial regulation, shaping the future of investing within the EU and beyond. The ongoing adaptations to this legislation underscore the significance of maintaining robust protections as market conditions evolve.